It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Okay, welcome back. Hey, Professor Rick Plum, Johnny Dean here, by the way, podcast host and moderator and all that. Professor Rick Plum sitting here with me, back in studio as we have been for the last few podcasts. But do you realize, Professor Plum, certified financial planner professional that you are?
Thank you.
Can I get your bona fides in there, your letters, your designation? You worked hard for that. This is season 6 of Managing Your Financial Future.
Wow.
Can you believe that?
Wow. It doesn't seem that long. It goes by quick, doesn't it?
Well, it does go by quickly. Now we have like 12 episodes per season.
So a season's not a year.
It's not a year like it was when we were kids.
Yeah.
Remember that? Every season was on TV was a year.
Is that how we're into American Idol season 700 already?
It's something like that. It should have begun back in the late 19th century. I don't know. I can't quite figure that out, but that's how they do things. And that's sort of how we do things here on this podcast. But season 6, I hope you've had a chance to subscribe. If you haven't, go to Spotify. You can find us there and subscribe to our podcast. You can download episodes and listen at your leisure or leisure, depending on where you're from. A lot of great topics, including today's topic, by the way. So we love to go through things. And, well, you do, and find...
I sometimes like to. Sometimes they just annoy me.
Well, I got this email from you not too long ago, and under the subject headline was irritating articles. And I said, uh-oh. Your first line to me said, "Sorry, John, I just had to vent." This, and you attached an article. This article is so misleading and improperly worded, it just makes me mad. So I thought we would go and talk a little bit about this because it's relevant in the sense that it discusses Social Security taxation. And in fact, the title of the article is "How to Avoid the Social Security Tax Trap," which is a good topic. And
it's important.
It is, and we're going to talk about this. But there's a lot, and maybe because of the confusing nature of Social Security taxation, some of the semantics,
and maybe they were just trying to make it easy. But
it's
taxes wrong. And easy don't necessarily go together because you do it this way and it can scare you away from doing what actually works well for you. So
they kind of intimate here that you're going to wind up paying more taxes on your Social Security than you actually will. And if they're trying to make it easy, well, here's the thing, in my opinion. If you want to make it easy and can't, or if the only way to make it easy is to give wrong information, just don't give the information.
Right.
Just defer to our podcast and listen to Professor Rick Plum. So here's the deal. Social Security is taxable, Professor Plum, and it has been for a while.
In some instances, not for everybody.
It's potentially taxable.
That's
for
a good way
everyone.
to say it.
And it has been since 1983.
It doesn't matter your age. There is no factor into the age of whether it is or is not taxable. It doesn't matter whether it's a survivor, widower's benefit, a retirement benefit, a family benefit, a disability benefit. If you're getting a check from Social Security as a Social Security benefit, any one of those that I talked about, doesn't matter what age you are, it has the potential to be taxable, and that can be an issue.
It can be an issue, even for people who, you said it doesn't matter your age. We've talked to people before who have had Social Security payments for 5-6 years and have had absolutely no tax issues with them, and then all of a sudden something else happens.
Like an RMD or something, or they sell a property or
some other income, and we'll talk about this, happens, and they wind up being shocked by the amount of tax that they have to pay on their Social Security.
I've also had people tell me that they're looking for their budget will open up when they hit 70 because Social Security won't be taxable anymore at that age, and that is not a true statement either. Your age has nothing to do with it.
So speaking of the taxation, it's based on what's called, I'll let you explain it, the modified adjusted gross income. But what happened was in 1983 they started taxing Social Security benefits for certain individuals.
Yes,
and it had to do with their modified adjusted gross income.
The tax code uses several different modified adjusted gross incomes, and this is the specific. There is a modified adjusted gross income for Social Security taxability, and so it's calculated a certain way, and they take certain incomes like all of the income on your tax return that shows up in the taxable column, and half of the Social Security that you receive. Now, that doesn't mean that half your Social Security is going to be taxable. That's just that's just a number that they use to then put into a formula to determine how much of your Social Security will be taxable.
If any.
If any, yeah, because if you fall under certain thresholds. And now, as you mentioned, they started this back in 1983. I think it was actually on the 1984 return. It was the 1983 Bernanke Commission on Social Security. And so it was set, the income threshold, the MAGI, modified adjusted gross income level, was set at $25,000 for a single taxpayer and $32,000 for a married couple filing a joint return. And in 1983-84 numbers, not when you're only looking at half the Social Security that was being paid as part of that modified adjusted gross income, it really didn't affect that many people. I mean, a lot of retirees weren't over that threshold.
It was a decent.
That's not your total income. Remember, that only included half your Social Security. So if your Social Security was, $20,000 at that time, only half of it was in the MAGI. So you could have $42,000 of income and still have none of your Social Security taxable.
Back then.
Still today, but and $42,000 of income in 1983, 84 for a retiree, you could probably make that work.
You most likely could. So what
but they haven't changed that number, that 25,000, 32,000 number, since 1983.
So more and more people are being subject to having their Social Security fall into the taxable column. Now, is it there was another one added in 1993? Not just there was another level,
another
of
layer,
layer
where they said that if your income, your MAGI, they didn't change any of the terminology, the calculation on that part of it. MAGI stayed MAGI. They only included half. All the other income, including tax-free income, your pensions, your IRA distributions, capital gains, rental income, all that kind of stuff. If it's on the taxable column on the Social Security, or not Social Security, on the tax return, plus the tax-free income from municipal bonds, and half of the Social Security, if that exceeds another threshold, then up to 85% of your Social Security could potentially be taxable. The upper thresholds were 30, I can't remember it off the top, 34,000. No.
44,000.
That's for a married couple.
Oh, I'm sorry.
It was 25 for 34,000. It was 34,000 for a
single 44,000.
And then 44 for a married. Wow. Gosh.
We talk about this once a week instead of once a day anymore. But anyway.
And those numbers haven't changed since 1993 either. So again, more and more people. Now these are not triggers, or they're not cliffs where if your income goes over it by $1, then boom, you're all the way into the 85%. It's not where if the threshold for a married couple is $44,000 and your modified adjusted gross income comes in at $44,500, it's not automatically 85% of your Social Security is taxable.
Yeah, so let's just say use a real. You said 44,000. What did you say?
Well, I said 45.
Let's say.
Yeah. Well, let's just say 45,000 is your MAGI.
All right. So $45,000 is my MAGI. In other words, that's my taxable income plus half of my Social Security. Right.
It's basic. Yeah. It's all the income that shows up on your tax columns. Add them all up. Add tax-free municipal bond interest in. Add half of the Social Security that was paid. Now, that's half of the Social Security that was paid, not necessarily half the Social Security that was received, because you're paying for your Medicare in many cases out of that Social Security check. And so if your benefit was $1,000 a month, you're not receiving $1,000 a month if you're paying Medicare, because you're only getting, you got 850-ish. So they're looking at the $1,000 a month number there, the gross.
But I didn't even receive that. I had it withheld from my check.
But you used it to pay for your Medicare.
For your Medicare. All right. Well, anyway.
So they add all that together, and that becomes your MAGI. And if you're at $45,000, you're over the second threshold. You're into the 85% level of taxability of Social Security. But you're only into that level by $1,000. Threshold was 44. Your MAGI is 45,000. $1,000 in. 85% of that number plus half of the first part of it. It gets complicated. There's some formulas. Once you see the formulas, they're pretty easy to follow. It's like a little if then. If you're over 25 or over 32, But under 44, if you're, it's all these if-thens.
Okay, but look, let's just
only a small amount of your income is going to be taxable at that
So
part.
if I have $20,000 of Social Security between my wife and me, right?
Okay.
And now our MAGI has been calculated at 45, which is just $1,000 over that, and I have $20,000 of Social Security. I look at that if I didn't know, and I'd say, oh man,
85% of my Social Security, $17,000 of my Social Security is going to be taxable. No, that's not the way it works.
No. So I would say, well, how much am I into that? How much above that $44,000 threshold? I'm 1,000 over. So now
you're 1,000 into the 85% threshold. You've used up the 50% threshold, but that doesn't mean 50% of your Social Security. That just means 50% of the difference from the first threshold to the second threshold. So at that point, instead of $17,000 of taxability of Social Security, and it's not 85% at that level, I've got $6,850 of taxable Social. A little over $10,000 difference just by doing it the right way.
By doing it correctly. Now, once you do your taxes, I would assume if you're doing TurboTax, you're not going to
computers all do
mistake.
it the same. The computers do it right.
Why do people need to understand? And I had thought we could explain it. It sounded awfully complicated the way we were doing it.
And that's probably why nobody really likes talking about it, because it is somewhat complicated. But we need to know where we are on that MAGI so that we can know how much we need to adjust, whether we're taking money out of an IRA, whether we're taking it out of a Roth IRA. Should we mix and match? Are we taking principal out of a bank account to live off of? How much if we change your income, the structure of your income, not the amount, but where it's coming from. I still want to have, $60,000 of gross cash flow. When you just said 20,000 of it or so is whatever the number is coming from Social Security.
That's not going to change. So that stays the same.
Yeah, that's not going to change. The other 40, where's that 40,000 of cash flow coming? Is it all coming from IRA? Or do you have personal money that we can blend in on this? Because we don't need to drop your overall income from a taxation standpoint a lot to get out of a heavy chunk of tax. We just need to drop it a little bit. So maybe we take some personal money that's principal more than taxable, and we take less out of your IRA. Or we're looking forward and we're saying, you know what? You got some room left. Let's take a little more of the IRA. Now, depending on where you're at, that may or may not be a good idea.
Well, okay, if I'm a married couple and I have $20,000 of Social Security and I need, you said 60, let's say, per year of cash flow, if that works.
Okay.
The first amount of income I want to be careful of is the which level? Before I have to start thinking about potentially having my Social Security be
Well,
taxed.
I mean, you're at $60,000, so I would start looking at the $44,000 threshold.
I've got my 20. I'm trying to figure out where to get the other 40.
Right. And so I think depending upon how you're structured, that's the first thing is, do you have majority IRA type money or majority personal money?
Now, if I have a majority of IRA type money, is that more harmful to me from a Social Security tax standpoint than say personal money? Like,
well, personal money can be, if I've got
define personal money.
Personal money is not in an account that's sheltered from taxation.
In other words, I could take it out.
It's brokerage money. It's bank money. It's money that I've already paid tax on, that I have either put in the bank or I've invested in stocks, bonds, mutual funds, whatever the case may be. But it is not in an IRA, not in a 401k, not in an annuity, which I could say that well, not in a tax-deferred account. And so I get taxed on whatever it's earning every year. But if I need that $40,000 a year, I could put, $200,000 in a bank account and draw $40,000 a year from it for the next 5 years. And it's not going to, and how much am I going to pay taxes at this point? If that's the only $40,000 I'm using for my cash flow, what is that $200,000 bank account earning right now? 3 cents? I mean,
assuming it's in something non-volatile.
I'm saying a bank account.
Yeah.
I mean,
so I can take that, and that's not going to subject any of my Social Security to taxation.
No, because there was no taxability. I mean, even at 0.5% that the online banks that are paying, that's $1,000. That just doesn't move the needle from a taxation standpoint. Because when I add half of my Social Security to $1,000 of interest, I'm nowhere near the first level of Social Security taxation. So if we've got personal money, we can use that to help bring down the taxability. If I don't have any personal money, now it's a matter of where am I on that threshold, and should I accelerate it a little bit to try to get more money out so I can build some personal or Roth money, or is there anything I can do about it? So it's just a matter of, the first thing I'm going to look at is, where are your assets? Are you primarily IRA type money, or do you have a blend of assets? And can we blend where we're getting our cash flow, our spendable money, should we be taking some from personal money and some from IRA? Now, in the case we just talked about, if I had that $200,000 in the bank, that means I have quite a bit of room that I can take IRA distributions and still pay no income taxes, because the first $10,000, $15,000, $20,000 I take out of the IRA, I won't pay any income taxes on. So maybe this is a good time to lessen the cash flow coming out of the personal account.
Well, that's that quote unquote 0% tax bracket that we talked about a few episodes back.
That's understanding how much I can take out without negatively affecting the taxability of my Social Security. And it's not a matter of saying I don't want any of my Social Security to show up on my tax return. I just don't want, on the taxable column, I just don't want too much of it to show up, because I want the combination of the taxable Social Security and the IRA and other income to stay within those limits, if I can, the 32 and the 44 for a married couple. And that way, I don't have to pay any taxes on anything.
That's the goal.
That would be a great thing. Now, obviously, if you need $10,000 a month to survive, your Social Security is probably going to be taxable. You're going to be more worried about hitting the income-related monthly adjustment amount than you are the taxability of Social Security.
So sometimes there's nothing you can necessarily do.
But in that case, it may be, depending upon how much Social Security you have, you've already maxed out the 85% of the Social Security, and you still have room to go in the 12% bracket. The bad part's behind you.
You owe the money no matter what.
It's a weird phenomenon where you go through
in for a penny, in for a pound now.
The first X amount of dollars of income isn't taxed at all. And then it goes to a higher tax bracket, because the next dollar that comes out, you pay tax on that and some of your Social Security. Then it goes up even more than that, because you're paying tax and on 85. And then it comes back down, the effect. So there's a place where the marginal, the amount of tax you pay on that last dollar out goes down quite dramatically in some cases. It can go down from like 22% down to, or 21% down to 12.
Because you're social.
Because I've already maxed out the hit on my Social Security.
Yeah, and they can't. The jar is full in that.
And
case.
so in that case, let's fill that 12% jar up, because we're not going to see that cheap money anymore. Yeah.
So you might run into somebody who has, $20,000 or $30,000 of Social Security, and they need another $40,000 on top of that to per year to cover their expenses. And so you're asking that. Well, the puzzle for you is, well, where am I going to get this from? And you run into people, I would assume, who say, well, I just retired and I've got, most of my money, frankly, is in my 401k.
$800,000 in my 401k and $200,000 in my personal account.
In my personal account, if even that in some cases.
Well, I'm just saying, if you wanted the $40,000, that fits right into the 4% rule.
So I have
real well.
$200,000 in my personal account. Now, there are those, somebody who's age 63, 64, there are those who would purport that, well, shoot, heck, you've got this personal money. Let's use up this personal money.
Well, live on it and be tax-free for the next 5 years.
Use it all up, or most of it.
Look, if you use that, just the personal money, you're not taking any money out of the IRA. None of your Social Security is taxable at this point because of the way it's being set up. You are tax dadgum free. That's tax-free. None. Zero. Nada. Zilch. Until you get to the fact that you've spent your $200,000,
and all I've got left is my
IRA,
$800,000 in my 401k. Let's say.
And in 5 years from now, hopefully, it's a little more than $800,000.
Yeah. So by now it's 900. I'm making these numbers up.
Yeah. But whatever it is, hopefully it hasn't lost money.
Yeah. Well, let's say it's still $800,000 for whatever reason.
So you've got you start taking all of your $40,000 out of that. Now you're going to have to pay a lot more in Social Security, in tax on Social Security, and it's just. There's nothing you can do about it at that point.
So your task as an advisor, Professor, will be to figure out a way to maybe take some personal and some
I'd say let's take
401k.
At that point, we're pushing ourselves into the taxability range of 85%. For every new dollar of income, we're showing 85 cents of Social Security is going to be taxable. If possible, I'd like to be able to limit that to maybe the 50% mark. and lessen the overall impact. So instead of taking all 40 from the personal account, maybe taking 15 and taking 25 from the IRA. That will subject a very small amount of your Social Security to taxation, a very small amount of your overall income to taxation. But that'll stay small for the rest of your life, instead of nothing for today and then a lot more for the rest of your life later.
This sounds, as I'm listening, I'm trying to do this from a listener's standpoint.
And trying to make it easy?
You can't make it easy.
And that's why that article ticked me off, because they tried to make it easy and they just made it wrong.
Yeah, I was going to read from the article, but I don't see the point, because it's just going to confuse people even more, because they had incorrect information as to what is included in your gross income.
And how it's calculated, and it scared the living heck out of people if you read it that way.
Well, people hear things. They hear the word 50% of my Social Security is taxed, which sounds to them that like it's taxed at a 50% rate.
Or 50% of it is taxed, when really only a couple $100 was.
Well, that's the next level down, which so they understand it's not a 50% rate.
I'm still surprised by how many people think that I have to pay 50% of my Social Security in taxes. The tax rate on my Social Security is 50%. Or the tax rate on my Social Security is 85%. No, the tax rate is not 50 or 85. The tax rate is whatever your tax bracket is, if you're in a certain bracket. At the 50% and 85% is how much of the benefit could potentially show up on the taxable column, could show up as part of your overall adjusted gross income before deductions.
At which point they look at your tax bracket and see how much.
Right, but it's not an 80. Right now, the current maximum worst case bracket is the 37% federal.
Currently. Expect that to change.
Currently, the worst case scenario is that 85% of your Social Security could be taxable.
Yes.
And under no circumstance in today's world is 100% of your Social Security taxable.
If all you have is Social Security income, due to the way it's set up, Professor Plum,
no, it would not be taxable, because I'm looking at if you had two very high wage earners who waited until age 70 and they're getting $40,000 each of Social Security, $80,000 gross. Okay, at that level, they're including half of it, so their magi is $40,000. But they still have a standard deduction and so at that point, you're still not going to pay any tax on it.
People, I think, also get confused with the regular tax brackets. You talk, you have the 10%, you have the 12%, you have the 22, I believe, 24 after that.
Yep.
And does it
currently?
Currently. Then does it go to 31?
32.
32. And then 37.
I think there's a 35 in there too.
Maybe. But anyway, that's for, I'm not there. So
I'm sorry to hear that.
Yeah, thank you. I'd like to be. No, I wouldn't. It's where people also get confused, because they think if they take, I'm in the 12% bracket. If I make, I'm just below the cutoff point for the next bracket up, 22. They think that if I'm $1,000 below,
then everything gets back to 22.
And I jump and I get a $2,000 bonus check that all of my income is taxed at 22.
Right. So I'm going to pay more in taxes than that bonus check in your example was worth. It doesn't work that way. It's a progressive system. We pay a higher tax on the later dollars, the latter dollars, whatever you want to. But it doesn't affect the early dollars. So the first X amount of dollars, for a married couple, the first a little over $25,000 that they have is going to be wiped out and not have any pay any tax on it at all.
Yeah. So if I have,
that's a standard deduction at least, and you might have an itemized.
Yeah. So if I had $125,000 of income, and let's just say no deductions, and I think we did talk about this before, but let's just rehash it. We're almost out of time. But if I had $125,000 of income, the first $25,000 would be wiped out by the standard deduction. Right. Now I have, I'm talking about America.
Well, if I had $125,000 of adjusted gross income, gross income at most is going to include 85% of the Social Security. It doesn't include any money you've deferred into your 401k. So it is adjusted.
It is adjusted.
And then they adjust it again by the standard deduction down to create what's known as taxable income.
Yeah, so now I'm at $100,000.
Right.
And so I would look at this and I say, okay, I got $100,000 of
taxable income.
So I've already taken the first 25.
If you look
off.
at that
so now,
100,000 is in the 22% tax bracket. You don't owe $22,000 in tax.
No, the first, what is it? The first 9,000.
First 19,000.
First 19,000
and change.
It's almost 20, actually.
Yeah,
I think it's
like
like 1908,
1909.
1909. Call it 20. So the first 20 is taxed at 10%. The next
roughly 41,000.
I thought it goes up to 80.
Roughly 61,000.
61,000.
61,000 is taxed at the 12%, and then the next 19,000 up to 100 is taxed at the 22. So you're taxed in blocks, but the block doesn't ever retroactive back to $1.
No, it doesn't, and there's just so many people that don't. I think,
and it's unfortunate because hopefully we are all dealing with taxes, which means you have some money, which means you have some income. When I said earlier to John that I'm sorry to hear that he wasn't in the 37%, 35% income tax bracket because his income isn't $500,000 or more, or given whatever the bracket is.
Yes, and I'm sorry I'm not paying an estate tax either. It doesn't look like I will be.
We live in a state that has a very high state income tax.
Yes.
As high as 13.3%.
Indeed.
And I can't remember I think you have to be well over $1 million, and only the income well over $1 billion. It's also progressive. And to be paying 13.3% in our state, you have to first off have well over $1 million of income for this year. Okay, I will complain to the bank all the way.
I said that. If you want to subject me to an estate tax because between my wife and me we have $22 million. Is it $23 million?
That could change very quickly, though.
I'd heard there was a proposal to bring that way back down.
I think the one I've heard most is $3.5 million each. But I've also heard it bring it back down to $1 million. I don't think they'll get it that far back.
They won't get it that far back.
But they are talking about bringing the gift exclusion down to $1 million.
So we won't have a unified credit.
Won't have a unified credit anymore.
Well, you know what?
That's all proposed. Who knows what will pass?
Yeah, who knows? Who knows? But anyway, the important thing is, this is why I believe you need to have somebody looking out for you. You need to have an advisor who understands this stuff. Somebody who can play with the numbers and actually enjoy it.
It's kind of a sickness.
It's a sickness, but it's a good sickness to have, because when you look at it as kind of a puzzle and you see, where do I need to take this person's income to keep their taxes potentially as low as possible?
And when we say as low as possible, we're not necessarily talking about just this tax year. We're looking at managing them this year, next year, the following year, from here out for as far as we can see, because you can do a lot of things to move your taxes to as low as you can this year, but that may or may not be the best thing for you, especially in the retirement zones where you, in many cases, have room to run at a tax bracket that is not very detrimental to your financial health. But in the future, when RMDs kick in and maybe some other things kick in, your taxes could go way up. We see this quite often, people waiting to take their Social Security until age 70. They get a much bigger benefit at age 70. They don't take any money from their IRAs until they're 72 now. And in the meantime, they're living off that personal, money, principal. They're paying no taxes until they get to a certain age. And then all of a sudden, boom, they've got required minimum distributions and their Social Security and a pretty good sized tax bill, much higher. They've gone through the 12% bracket. In some cases, they've gone through the 22. Now they're in that, 24, 35% bracket, if they're lucky enough. And they're going to be stuck with it for the rest of their life. If they had done something early, they could have used up the 12% bracket that they were going to pay anyway, just a few, and maybe avoided some of those higher brackets in the future.
So you're saying if you're going to pay if you have to pay taxes on the money pretty much anyway.
Well, if you know that in the future it's going to be 22% or higher, but you could pay 12 today, that's a good trade-off. And now, for people saying, well, they could change the tax code on us. Yeah, they could, and they very likely will change the tax code on us. But I don't see the brackets going down. Now, I could be wrong. I just don't think that they're going to go down in the future.
I don't see it going down, certainly not on the high end.
Well, even on the middle, I don't see them going down in the middle area. I don't see them changing the brackets. I mean, but who knows?
Yeah, who knows? But you can't play with that. You play what you use the rules.
Well, what I'm saying is if they're going to change them, it'll probably go the other way.
The other way, yeah. Yeah, I do know people who are starting to take, they're starting to take money out of their 401ks and IRAs. I'm not saying that's a good idea. It may be a rotten idea for you. It may be a great idea. But I have seen people start to get worried. And
it may be a time to look at it and say, well, if I'm in the 12 now and I know I'm going to be the 12 maybe more in the future, I know I'm going to be paying the 12 anyway, I'll do some, if I don't need the income to live, I've had a lot of people tell me, well, I can't do a Roth conversion. I'm not working anymore. Working only means that you can contribute to a Roth. You do not have to be working to convert existing tax-deferred 401k IRA type money to a Roth IRA.
There used to be an income limit to converting.
They got rid of that in 2010.
2010, and we haven't seen it since.
Right. It used to be that if your adjusted gross income was over $100,000, you could not do a conversion.
Married or single, as I recall.
Right. It didn't matter your filing status.
You couldn't convert.
You couldn't do a conversion. And then Congress realized they weren't raising enough tax monies.
You think they ever call the IRS and say how much tax money we have coming in? No.
Well, they know how much their revenues are.
No, they can guess. But at any rate, this is why it's important, I think, as I was saying, to have somebody looking out for you, somebody who can help you figure this stuff out. Because I think sometimes even the smartest minds, Professor Plum, if they're not actually working in the industry, it's very easy to get lost. It's very easy to make a mistake. Not that an advisor can do everything perfectly every time, but to have somebody who works in this and understands how all this works, I think is very important. Somebody might want to get in touch with you, Professor Plum. They can reach you at 800-644-1150. The number at Lucia Capital Group, longtime sponsor, 800-644-1150. You can go to luciacap.com, LUCIACAP.com, and email the professor. We've got a whole team of people working.
Well, and I was just going to say, if I'm not immediately available, you can always ask for any of the other advisors that work for Lucia Cap, and they can help as well.
I'm lucky I can nail you down just for a podcast, quite frankly. I have to sort of lure you in with popcorn or something. I don't know.
Yeah, and I don't see it. Where you promised me?
Yeah, I know. I promised you. You know what my you know how good my promises are, don't you? But I do promise you that Professor Plum will at least get back to you, or one of the Lucia Capital Group advisors. 800-644-1150. Talk to them about your Social Security taxation. Talk to them about the potential of that. Talk to them about required minimum distributions that you may have coming up. Are you potentially subjecting yourself to taxation that you may not have to necessarily do? Find out. 800-644-1150. Professor, thank you so much. We're back next week with just a beautiful topic, I'm sure.
Hopefully a little less technical.
I hope so, too. We'll make it a little easier next time. For Professor Rick Plum, Certified Financial Planner Professional, I'm Johnny Dean. Thanks so much for listening. Don't forget to subscribe on Spotify to our podcast. Listen to every episode. Get it downloaded right to your device. Spotify. For Professor Plum, I'm Johnny Dean. Thanks so much for listening. We'll talk to you again real soon.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.